Good evening.
Let me take a moment to introduce our guest for today. Today we have Aditya with us, author of the great book, The Polycycle Investor. He is an investment banker by profession, but investor at heart. So in the past, he had led IB teams at Axis Capital and Edelweiss. And apart from that, he's a strong proponent of value investing. But over a period of time, he has devised his own investing philosophy, which is both dynamic as well as long term. So during the course of discussion today, we'll be getting to those things, and we'll be asking Aditya on various cycles which he has elaborately discussed in his book and various case studies in Indian context. So this session is going to be really interesting, and please feel free to send in your questions, or you can also send in a speaker request so that we can take those questions with Aditya. So Aditya, very warm welcome.
Thank you, Prince.
So Aditya, how it all started for you? Where did your journey began, and how it evolved over a period of time? So if you would like to tell.
First of all, thanks a lot, Prince, for having me on this session. It's a really great honor, and I can see we have a lot of people whom surreptitiously or directly I've been following as FinTwits, and they are all very, very capable and qualified investors in their own right. So I hope today's session is worth your respective time. In terms of my journey, I started investing fairly early. I got into an investment bank, started investing. Investing was always my first love. And obviously, like most people, you when you start off value investing, there are certain people like Peter Lynch, Howard Marks, Warren Buffett. In Indian context, people like Manish Pobrai, Sanjay Bakshi, who was also my professor at my B school. A lot of these people, you read literature from them, you read about their investing style, and initially obviously you start imitating those. You make your own set of mistakes, and gradually, like it happens with every investor, you build out your own style. In this context, obviously, for any value investor, I think reading is a very, very important piece of learning, whether it is to build your style or to understand the balance sheets of various companies, what can go right, what can go wrong. So I think that is where predominantly it evolved. Being in a industry which gave you exposure to various corporates, the promoters, also ingrained in my mind the importance of corporate governance and why the quality of the promoter that you are investing with is extremely important. You may invest in a great business, but if the promoter does not want you to make money as a minority investor, you might still go wrong in spite of all your financial diligence and understanding of the annual report. So that has been one of the lessons. Over a period of time, also what I realized that a lot of literature in India was very, very quality centric. Uh, People started talking about quality at any price, or you know willing to pay 90 times earnings, 100 times earnings to some stocks which were anyways doing very well. So the expectation of growth and everything becomes a little tricky when you talk about well performing stocks at a very, very high P. So in that context, I felt that the investing philosophy for even long term investors need to be a little bit more dynamic. There are always times when a certain sector runs ahead of rest of the market. For instance, digital was running ahead of the market lately. Before that, it was in 2008 to 2006 to 2010. Your real estate stocks and some of the infra stocks were running ahead. Uh, then the NBFC boom came in 2015, 16, 17. So a lot of stuff was trading at 7, 8 times book also, some even with questionable pedigree and all. So in all that context, one felt that the investing style also needed to be a little bit more dynamic to evolve and to be able to make a long-term return. So that is where the entire thought process started. And like a lot of us, had lot of spare time during the COVID lockdown. So I used that time to write this book, and very, very enriching experience. And I'll encourage the readers also, the listeners also, to grab a copy. I'm sure you'll find it worth your time.
Great, great. So, Aditya, like when it comes to timing the market, this is in itself a controversial thing because people carry different opinion on it, right? Those who are into technicals, they primarily, I mean, try to time all the time, right? And those who are into, say, value investing, they think like timing the market consistently for a long period of time is something which cannot be done, right? So what's your view and take on this, and how you think we can time the market to our benefit?
So technical investors are a very different ball game. So I have limited understanding of that. So I don't want to comment on it beyond a point. But when it comes to value investing, right? I partially agree that timing is obviously, difficult, and in a market like India, which is otherwise probably the darling of the uh, investor community worldwide, you cannot afford to be out of the market ever, right? But at the same time, your capital allocation strategy has to be dynamic. If your market is at a 12 time PE, your allocation of capital in equities cannot be same as when your market is at a 25 times PE. That is the limited purpose I was talking about. So personally, when I look at it, my capital allocation typically varies between 50% of my surplus capital to 120% of my surplus capital in equities. So if the market is really, there's blood on the street, there is, something like what happened during COVID or global financial crisis, that is the time you get a lot of high quality stocks at 6 times dividend yield, 7 times dividend yield, 7% dividend yield, 6% dividend yield. You get high quality banks at book value. You get a lot of other companies, the top FMCGs at mid-teen kind of P. So that is the time you find it very, very difficult to keep capital at home. So that is the time where if you invest and you're brave enough, because obviously when the market is crashing like that, there are uncertainties. There are even sometimes people have issues with respect to job certainties and all that issues, right? So that is the time, if you still have the courage of conviction and you're otherwise relatively secure, you can really go the distance and do a much, much larger capital allocation. And vice versa. In a market like today, where we are at an all-time high, Sensex P is close to 25, you will find it very difficult to be 100% invested in equity. You would want to have some dry powder if something goes wrong, markets, there is a correction. You're in a position to, deploy capital if market corrects at some point of time.
Right. So, Manish, please feel free to come in between if you have something to ask or maybe add on I mean, what we are discussing with Aditya. So, Aditya, you talked about underinvested industries, right?
Right.
So, how to, I mean, what we say, how to fish those kind of industries in the sense like looking for the market inefficiencies and benefit from that.
So a lot of it is thematic. A lot of it is driven by what you read in newspapers, right? So, for instance, I remember there was some issues with one of the large basmati rice companies, which happened a couple of years back, and the entire universe got beaten down. I, as a investor, like basmati rice as long as you can find decent corporate governance companies or people with track record quite a bit, right? Because I feel that it is increasingly a brand play, it is a premium play, and it does not get valued like a brand. So when you get opportunities like that, you invest in it. Similarly, if you look at during the COVID time or after that as well, your real estate stocks were deep in the dumps. So if you could identify guys who are uh, not very highly leveraged and had a decent pool, something like a DLF or something, there was very little chance of that going wrong. Even today, if you look at so now auto, obviously a lot of companies have run up, But if you look at a couple of companies in the space like lubricants, or if you look at print media, obviously both these industries are in huge stress, and they will be cleaning out in terms of some people dying out, some people uh, losing market because the market itself is expected to decline. But at the same time, what happens is that a market leader consolidates his position and he keeps on, for instance, let me take both these examples one by one. So if you look at lubricant space, Castrol is a MNC, very high corporate governance, good dividend yield stock available at a 15 times PE. One might say that EV coming in would, reduce the market size itself. But what is happening is that the EV evolution will take its own sweet time. And during that period of time, they don't need to do capex. So the surplus cash flows will be available in a big way. Secondly, if you're an industry leader tomorrow, even for EV fluids, they could be one of the better bets. So while everyone is not looking at this sector, I think if you bet with an industry leader with a good corporate governance, someone like a Castrol, there could be money to be made. Similarly, even in print media, people like Dainik Jagran or Dainik Bhaskar, these are market leaders in their own right. They are in vernacular where the literacy rate increasing and in the prosperity coming in the so-called cow belt will increase readership. But at the same time, what will also happen is that some of the marginal players will keep getting cleaned out from the space because the ability to pay the reporters, ability to pay for good quality newsprint, ability to uh, invest in good quality content will only be there with the leaders. So I feel that some of these stocks can re-rate significantly. But just because the print media industry itself is on a decline and we feel that the younger generation is all moving to reading or consuming news through their mobile phones or through internet and everything, print media will completely die out. I don't completely agree with that. So some of these spaces looks interesting. So you have to look at it thematically.
Like you also mentioned about the SIP thing, right? If even if we are doing passive investing, we can some way, in the sense, time the market, right? So, would you like to touch upon that?
Sure, sure. So I think SIP, by the very concept of SIP, right? It is based on dollar cost averaging. That because you are investing equal sums on a monthly basis, you are buying larger number of units when market is down and fewer number of units when market is up. That is why your SIP returns are expected to be slightly better than your index returns. But if you could work on a model where you can reduce your SIP, like in a market like today when the Sensex P is beyond a acceptable range for you, and increase allocation when your Sensex Ps are lower, and for most parts stick to your regular investment pool, I feel that you can increase your return disproportionately. So if you're expecting to make a 12% return, you can easily notch that up by 2-3 percentage points if you could manage your allocations for SIP also accordingly. So I so sorry, just wanted to spend a little one more minute on the SIP piece. So I think SIP is a great instrument. I'm a huge fan of SIP as a product, and I think entire country is now becoming a huge fan with almost 13,000 crores of SIP money coming in every month. Uh, Having said that, what is also important with your SIP allocations is that you also have to at some point of time see what's your investment horizon, how you want to monetize, and how you wish to diversify your investments in the SIP piece. So I remember couple of years back when all the so-called FANG stocks were on fire. A lot of people got into investing in US for those returns and have burned themselves badly. But now we are sitting at a stage where a Facebook is available at a 12 time earning, a Google is at a 20 time earning, and people are not willing to do that. So even with SIP, where you put in your money, which fund, which asset class becomes reasonably important. So you don't want to be in a situation where you're putting in US stocks when they are at a premium, and then moving your SIP money to digital when digital IPOs are happening and screw yourself that way. So it's important that your sector allocation in SIP also, or the vehicle of your SIP also, is extremely important.
It's a pretty interesting point that you make, Aditya. And I just wanted to pick your brains on this topic of SIP. Uh, isn't it counterintuitive that, in fact, you're much better off in starting your SIP at a peak? And when, as the market falls, your SIP is getting more and more potent as you're collecting the NAV or the points, the units at cheaper prices. So your point is valid. The caveat remains that you have to continue the SIP and not panic. But if we are taking care of that dynamic, that the sipper will not stop sipping, actually starting off at the peak is a much better thing than starting at a bottom. No.
No, not really. I mean, in fact, you should allocate more capital when markets are cheaper, right? So when you start off, there is no bad time to start a SIP. You should, if anyone does not have a SIP, you should start it ASAP, irrespective of the market, right? But in terms of allocation, you should allocate a larger pool of your capital when the markets are down, and a lower pool maybe at when markets are at a peak, so that you build some sort of a ability to make a higher return on the market dynamics as well. And these are not very difficult things to do. You can, use Sensex P's as a proxy to make some sort of a
Right.
framework there.
So, Manish, I think one thing that would also depend on is how low he started investing on the SIP, and how, like, what was the fall from the top.
Yeah, yeah,
So
I
if
got
he,
that.
yeah,
I was presuming that it's a consistent same amount throughout. In that sense, starting at the top is actually more beneficial than starting at the bottom. We did this test actually. Starting the SIP at the top is actually more profitable, more CAGR compared to starting at the bottom. Of course, as the concept would tell you, dollar cost averaging, you are getting more and more units as the price is falling down. But his point is totally different. He's referring to change in the SIP amounts as well, where you load up big when the market is cheap. Yeah.
no, no, no. See, my point is that if you start at, let's say, one, okay, and you continue until 100, and let's say market falls by 20% from there, or 30%, right? So your magnitude, you would still, get the benefit of 70, no, which you like started from the bottom. So my point was how low you started and how high the market went, and how
Right.
how deep the fall was.
Right.
That
Right. I
will
So
got
decide.
that.
Okay.
rather than, at least in terms of my framework, I mean, there is no right or wrong way to do it. In terms of my framework, rather than when I started or what I did in the past is done, it's in a way sunk cost for me. The way I look at it is what is Sensex P today and what I'm allocating today. So I might have invested, I might have started something, say, at a 10p or 12p of Sensex. I will not reduce my my allocation even if it reaches 18, 20, 22. I'll start reducing my allocation only when it starts, whatever my framework is. For me, it is probably 25. So the Sensex P crosses 25, I'll start reducing my allocation for SIP.
My entire point was that generally speaking, when you are in the accumulation phase, market falling is a good thing for you. Whereas market
Absolutely.
rising is a sad thing because you've not accumulated much. Your initial part of your SIPs are hardly moved anything, and already zooming, which is
So I
not a
think,
good
Manish,
thing.
what you are saying and I am saying, I think we are saying exactly the same thing. That
Yeah, true.
your SIP gives a larger return if you are allocating or buying more units when the markets are down. Only thing I'm saying extra is that anyways, SIP as a product does that for you. I'm
Yeah.
saying you can consciously also try and benefit a little bit more on that by
Yes,
playing on
Aditya,
your
I got that
allocation
point.
of SIP. Yeah.
So Aditya, like you also talked about the currency cycles, right? So there are occasions when you say the currencies are available less than the intrinsic value. So what are those occasions and how one can
So
read that and how that can be, I mean, beneficial for investors?
for instance, India is a classic case there. India, in terms of your dollar GDP, is close to $2,500, while as in terms of your PPP GDP is at about $7,000. Right. So what happens is that if you look at it, there is Indian market in terms of dollar investment is anyways cheaper. So my sense is that Indian currency will depreciate less than the average inflation rate of India for the next decade. So if you are a foreign investor who's looking to invest in India, you will make additional return in India because your currency return will be higher, or your currency depreciation will be lower than the inflation rate. So even suppose inflation adjusted in terms of real returns in local currency, you expect as a foreign investor in India, say 8% or 6% as a inflation adjusted real returns. But your dollar returns could be higher because your inflation could be 6%, but your rupee might depreciate only by 3% over the next 10 years at a CAGR basis. So this is something which has happened multiple times. It happened in Greece, it happened in Brazil. And the best part when it happens is when there is a change in the government, a lot of places where a fiscally reckless government is replaced by a government which is either by larger governments like IMF and US are pushed to get fiscal discipline in, or the government on its own gets the fiscal discipline in. So I think that is the time to bet on the currency. So you look at Southeast Asian when the currency crisis happened, and after that they were looking to correct it. That was a great time to get in some of those Southeast Asian countries. And the Sensex returns from a dollar investor perspective, or sorry, the index returns from a dollar investor perspective far outstrip the returns on the local currency basis. So that is the point we are trying to make. And India is a classic case there. India has been undervalued for whatever reason. India's credit rating also, I feel that most of the international credit rating agencies have been unduly unfair with India, which I think Nilesh Bhai and Manish Chokhani also has repeatedly said, and I completely agree with them. So India's credit rating will improve. India's inflation will be in control because we've become fiscally slightly more responsible, and our purchasing power will increase, and it will get aligned with the with uh, our dollar GDP will and the PPP GDP difference is going to get reduced over the next decade.
Okay, all right. So, Aditya, you talked about various cycles, be it credit, market, commodity, product, and all. So, which one is the easiest to guess, or maybe we can uh, know that where we
So,
are placed in that market, and which is the toughest as per you?
I think some of the examples that I took, like the print media or the lubricant, is a classic product life cycle play. So it is actually about your own circle of competence. I might even within the commodity play, someone might understand steel better, someone might understand cement better, someone might understand BOPP, BOPET better, someone might understand textiles better. So, depending upon what someone might understand paper better. So, depending upon what you read upon and what stocks or what sectors you follow, it becomes that much easier to track that. The challenge with commodity play always is buying too early or selling too late. So that is the difficult part, and if you're closer to the sector, it becomes slightly easier. So I think that is one thing one has to look at. And typically, the trigger is when you start feeling that the average capacity utilization over a longer period for a sector has that threshold has been breached. So if in a cement industry, everyone expects that average capacity utilization is 70-75%, and the moment it starts nudging towards 80% and still the cement prices have not run up, that is the time to get into. And the time to probably get out is either when you see a lot of capital market activities in a sector, or when you start hearing a lot of capex announcements in a sector. So that is when the demand supply again starts getting screwed and your pricing power goes away from the producer. So commodity cycle works like that. But I would not say it is about individual circle of competence. I might understand something better, someone else may understand something better. Uh, so that is how to play some of these cycles.
Right, Aditya. So, Aditya, like we talk about, you talked about cement space, infra space. So, where you see, I mean, currently, if we say from this point in time, how you see these two sectors doing?
So I think the individual companies will do well, but I think the pricing is already not something which is very cheap. Iron and steel and cement, they've all seen their own fair share of run. But I think the next thing which might get be of interest going forward would be your building material space. Your selectively real estate has also run up, but I think there will be still some upside on the real estate side. I think PSU banks look very neat. They've been uh, trading close to point 0.5, point 0.6 times book for a fairly long time, and that was because their book was not correct. But I think a lot of problems with the bank books have now been addressed, and with the Insolvency Act, the very desire to be stupid about things with the promoters and hope that there will be a CDR, corporate debt restructuring, or there will be an OTS with the banks. That by design has kind of gone away because people now really fear that their companies might be taken into NCLT and they may lose the company. So everyone is slightly more worried about their debt equity ratios, their leverage, and want to manage it better. So I think the banks are going to do better. So if you some of the PSU banks in last couple of months have run up, but I think there is still a lot of steam left there. But I'll still stay away from other PSU lenders, non-bank lenders, because there I feel the systems and the oversight is still fairly weak.
Right, Aditya. So, like you talked about the investing philosophy to be dynamic, right? So, would you like to touch upon that? Like, if we say from the identifying the idea, basically screening, till what are the pointers you look for, and how you position yourself, maybe start slow or build your position. How exactly you go about your investing?
So for me, start slow or this thing is dependent upon how long I've been tracking a company. So if I've been tracking a company and I've been waiting for it to come to a certain price point, I might not necessarily start slow. But if there is a company where I don't have a particular view in terms of how they handle adversity or the quality of management or something, then I might start slow and keep it under radar for some time, but invest a certain pool of money, say 20%, 30% of my desired appetite, just to see and keep it under my radar and track it more actively, and then take a larger jump. Uh, Sometimes your opportunities are so mouth-watering that it doesn't make sense to start slow. So, for instance, if for whatever reason there is a huge market crash or something, that is the time like there was an NBFC crisis or the COVID crash or the GFC. Those are the times you really tank up aggressively and uh, try and allocate maybe whatever surplus you have, 15%, 20% every month.
Right, Aditya. So, Aditya, so when it comes to selling, right, selling is always full of regrets. So, is there any set criteria for you to sell, or how you go about it?
Uh, well, to be honest, that has been my actual skills as well. Few stocks which I thought I haven't made great money on, and after I sold, they've again gone threefold, fourfold. So that is always a slightly more tricky piece. But with respect to some of the stocks like commodities and all, it's a slightly easier thing to take a call in terms of, like I mentioned, capex announcement, capital market activity. So it becomes slightly more easier to take a call. Some of these secularly high quality companies, like the IT companies, or one of my mistakes in terms of selling, although I made a killing on that stock, but if I would have held, I would have made a further killing, is SRF. So some of these stocks uh, can surprise you with their performance immediately after you sell also.
Right,
So,
right.
I don't know whether I've been able to answer your question completely or not. But in terms of commodities, like I said, capex investment is high, please sell. In terms of some of the other stocks, look at certain multiples where you feel that I am satisfied. So even a great stock, probably I find it difficult to hold beyond a 50-55 PE, irrespective. So some of those thresholds framework, it's all subjective, but some of these frameworks you need to have. For instance, HDFC Bank had been a killer in terms of return for forever. So, but I found it very, very difficult to hold it at 5.5, 6 times book. And if you look at it today, I feel that now people like, I don't know, I'm speaking purely as a consumer, but in terms of your consumer experience, some of the other private sector banks like ICICI and Axis, in terms of their tech stack and tech infrastructure and the kind of market communication they've been making, they are kind of bettering HDFC. At least that is my personal view. So I think one has to be slightly dynamic about that also. Just because HDFC has given return over the last 25 years, we to just stay with HDFC probably is not the right way to go about it.
Right.
So Aditya, just had one quick question. On the is it something like intermarket analysis that you follow to catch a, let's say, a commodity cycle or a, credit cycle or something like that? Or are there any like intermarket analysis domestically and internationally that we can use?
Not so much, to be honest. But obviously, if you're looking at a commodity which prices is determined globally, you have to look at global demand and supply situation also, right? For instance, textile, in spite of, I think that the domestic consumption is going to be fairly strong and robust in India, but textile is a fairly export-driven industry in India. If there is a recession in the US and Europe, the offtake might still be impacted. So some of those commodities you have to look at markets globally also. I don't know whether I've understood your question rightly or not.
Yeah. I mean, so my point was exactly was that only. So let's say, for example, we do intermarket analysis on emerging markets or the the US markets or European markets. So does that have something to play as like Indian outperformance or underperformance? So because
So
in your
I
book you talk about this. Go ahead.
So that was more from, so I personally at least don't invest that kind of capital overseas. But if I have to invest today, I don't mind buying a Facebook stock or a Google stock. I'm not so sure about Amazon, but definitely Facebook and Google is something I wouldn't mind buying at today's price. Uh, Similarly, I always feel that you have to operate in your own circle of competence. So I have limited or I would say I understand Indian market way much better than any other geography. And India is a stock picker's delight. So I've never felt the need to look at market outside. But what is increasingly happening, especially with this 13,000 crores of SIP money coming in India, I think Indian market is going to get more and more expensive, and Indian investors will look at lot more asset classes, whether it is unlisted equity, whether it is global equities, whether it is the bond market. So the asset pool to be invested in India is going to change significantly. I don't think, in terms of the overall size of the capital market, we can absorb this 13,000 crores of SIP for a very, very long time in India.
Right. Okay. And my second question was regarding, like, you spoke about like different cycle like credit market, commodity, product life, and all. Are there any specific indicators that you use to see whether some part is overheated, or
Mm.
if something is like making a bottom of the cycle or something like that?
So honestly, a lot of it is just market awareness. And when I say market awareness, it does not mean any insider information or anything. But if
Hmm.
the credit offtake is disproportionate, if I feel that what is happening in the market, like it was happening for the real estate space, or if you are seeing that every NBFC, I am very, very clear, if you see more than three IPOs in a particular sector in 1 month, that sector is superheated.
Hmm. I see. Yeah,
Right?
that's a good point.
It means that the
And
invest that the promoter feels that he is getting more than his fair value, and that is why everyone is queuing up
hmm.
to list or to raise money from the market. Secondly, having said that, unless you're going with very, very robust checks in terms of understanding how they take credit quality for a ordinary retail investor, I feel that the NBFC and the banking industry is one of the most difficult industries to take a call on, because unless you know which company has got its credit metrics and quality of credit perspective right, because by definition the raw material for these companies is money, right? So it's very easy to give out money and build a book, but if someone is giving out money just to build a book and not to get it back, somewhere it is going to come and bite you back, and which has happened over the last three
Right,
four years, and we're still trying to correct that.
right, right. I mean, in any case, they have a levered book, so your both your good decisions and bad decision amplify.
Correct, absolutely,
So
absolutely.
yeah, I agree with that. Yeah, thanks for answering, and thanks for all such a great book.
Oh, I'm glad you've read that, Shashank.
Aditya, if we ask about the asset allocation across, I mean, your allocation across various asset classes, so how you go about it?
So right now, uh, so the way to look at it is that when the markets look expensive, it's almost impossible to get out of the market. But you reduce the quantum of money invested in the market, and you reduce your exposure to riskier stocks. So, for instance, if I have to, today invest in say a Coal India or a ITC, I can sleep peacefully, in the sense that I know that my dividend yield will take care of my returns even if the market crashes disproportionately, and even if they fall, they will not fall as much as the market will fall. So I can always monetize them and buy something which I find it mouth watering. But at the same time, probably, I don't know, ITC I'm still fairly bullish on, but something like Coal India, I understand that probably will not be a four bagger for me. But I know it's a safe investment for me. So you also manage your allocation within the equity space in terms of what is defensives, what is uh, in terms of where your aspirations of returns are of multi baggers kind. So you always have to play that game and decide when to allocate where. So this is not a market where I feel that I can make a 15-20% return on equity over the next 3 years. So that is why I might want to, even at the cost of portfolio return, I might want to park something in FD or something in Coal India or dividend yielding stocks, so that if tomorrow market corrects, I'll be able to shuffle my portfolio and take those calls. Also, I think depending upon how much time each of us spend in terms of all this, one also should define the number of stocks, maximum number of stocks you wish to hold. Right. So if certain stock has not done well for you, rather than being afraid of booking losses and all, just sell and if the company is not doing well, just sell and invest into something which is likely to do better. So I'm very happy booking losses. I'm more reluctant to book profits.
Right, right. So Aditya, like when it comes to cash, how much maximum cash you can have any point in time, say if the market is say overheated or maybe likely, or what
Like
is
I said,
the
I moved from 50% to 120%. So
okay?
right now,
So
historically, except for the last couple of years, I've never had gold in my portfolio, except for my family jewelry. I don't count in investable surplus, but as an investable asset, I've never had gold in my asset. This thing, but right now I'm holding significant amount of my not significant, but a decent chunk of my portfolio, uh, good 5-7% in gold, because I feel that if the globally there is going to be an inflation, and it is a global commodity gold, and if at some point of time US dollar or the your euro is going to come under pressure, your gold will by default appreciate, right?
uh,
Similarly, because real estate has not seen a very great cycle, if someone is can has a decent understanding of a certain micro market and feel that real estate will do better, it is not a bad market to get into real estate. uh, like I mentioned about, I already talked about US equities. So one has to have 3 4 baskets where you have some view and you take a call and move around. So, for instance, I remember when before the NBFC crisis, I had done a large chunk of my investment in Bharat bonds, right? Because interest rates were at an all-time low, and it was as secure as this thing, and you were getting almost 9-10% yield on all Navratna companies of India, which is kind of as good as sovereign. So it made sense. I had invested in that, and then I encashed it after the crisis and invested in some of the better stocks in 2018. So some of these pools, I mean, I'm not even averse to investing in FDs. I know it makes worse returns than liquids and some of the other very safe corporate bonds also, but it gives me a kind of a mental peace and liquidity. So I'm okay to see 2 percentage points for that.
right, right. So Aditya, how you see special situations in Indian context? So you participate in those or you give it a pass?
Uh, Very difficult question to answer. Uh, Sometimes opportunity sizes are really good, but honestly, I've not made too much money on special situations. For instance, I had once played on HB portfolio versus JP. So HB portfolio, which had a sizable chunk of JP stocks, was trading at a steep discount to their holding of JP alone. Right. So I had bought that, but unfortunately, JP itself tanked after that. So that special situation also went for a toss. So there could be some pieces, but honestly, I've not had great success on special situations here, to be fair.
Right, right. So, Aditya, let's talk about your mistakes in the past. So, would you like to tell about what all mistakes you did and what were the learnings from them?
So one is that uh, cash flow is king. So one is that whenever you invest in a low PE stock, please see whether what is the quality of earnings. If you see that their working capital is getting bloated, if the leverage is increasing, probably the growth in profit is just to sustain their bank lines. So you understand, right? If I am a stressed company and I have, say, 200 crores of working capital limit, and I have incurred a loss, I am tempted to show profits and bloat my inventory so that my working capital line I can increase from 200 crores to 220 crores. So there is profitability also, there is a working capital asset also, and I get lines also to make sure that I don't get into a cash flow problem. Right. So those kind of things is something one is which you should be very, very careful of. If someone is showing profits, but those profits are not getting reflected in cash flows and they are leveraged, probably the books are cooked. So that is one piece which one should be very, very careful of. Secondly,
Right.
uh, sorry.
Yeah, go ahead, go ahead.
Yeah. Secondly, in terms of if you are looking at a real small cap, mid cap company and they have had any kind of debt restructuring in the past, any OTS in the past, uh, just do double your diligence because this is a very ugly habit which a lot of promoters get into, where they feel that it is a done thing to do and to screw the banks. So if you screw the banks, your equity returns can never come in, right? So if someone has had OTS and all, if someone feels that it has genuinely happened because the cycle screwed them the other way around, but the company and the management otherwise is good, please go ahead and take a punt. But other be do your check doubly. Mostly, I have seen that there was a cable company I invested in at a $60 price. It went to 220 bucks, and then eventually sold at $15. The same story. Both the things, both the examples I gave, they had had an OTS earlier, and I did not look at their cash flows. I was looking at cheap PE multiple and their jazzy investor presentation. I missed out on the cash flow, and I got jacked. So I think these are a couple of things one should look at. Thirdly, I think mental peace is very important in the market. If you are financially stressed for whatever reason, don't overplay your hand in equities. Uh, Unless you can take your own timing decision independent of your own financial situation, your portfolio returns are going to get compromised. So if you are looking to have cash flows from your equity investments to sustain your lifestyle, that is not a very happy position to be in. One should look at it differently and be more conservative on equities. You're better off liquidating your portfolio to meet your needs rather than looking at doing a lot of activity and making a quick buck. Invariably, people get into deeper trouble because of that.
Right. So, Aditya, let's talk about the bull traps and set traps you discussed in your book. So, we would like to listen on that front also.
So, satraps is a very interesting concept. Basically, what happens across the market is that the institutional money typically chases companies of a certain scale and size, and to invest in a very very large company or in an industry leader of a large industry, there is very little competitive advantage we as retail investors have vis-a-vis the institutional investors. They have they have the management access, they have access to all kind of research reports, they have access to all kind of industry reports. So their competency in those spaces is significantly higher than us. But if you want to partner in a leader, in an industry leader, look at industries which are probably less than a $1 billion size, 8,000, 9,000, 6,000 crore का इंडस्ट्री से size का जो leader हो, if you can participate in that, right, typically they will give you disproportionate returns. There are two, three advantages or moats they instinctively had. One is that because they are leader, they are probably a top brand, their cash flow generation and market access is superior than competition. Secondly, because the industry size is so small, you will not have a say a Reliance or a Adani or someone who is trying to disrupt that industry and gain market share by blowing up a lot of capital. So those industries typically still continue to work on a fairly commercial basis and they are not looking to be disrupted by people with large pools of capital. Some of those industries also started getting disrupted through startups because the startups were raising a lot of capital. But I think now we are in a situation where probably that will also not happen too much in a hurry. So a lot of these startups will find it the hard way that some of these businesses are not the easiest business to do. So, for instance, like we talked about building materials, so or tiles industry or a sanitary ware industry, or we talked about basmati rice industry. We talked about the print media industry. Your even paper industry to an extent is slightly larger, but will probably it's not large as some of the other commodities. Some of these industries, if Symphony was a great example in the cooler space, or your Relaxo, although some of these stocks have been found, but Relaxo was a great example in the Hawaii chappal space, right? So some of these, if you could find early, some of these leaders, they can make your returns of a lifetime. I remember one of the stocks which I invested in that theme was Hawkins pressure cooker, extremely strong brand, and in 2010 it was available at an aggregate market cap of 175 crores. So I just generally called up a few of my friends who invest and all. I just called them and just asked them one question: what do you think a Hawkins brand should be worth? All the answers I got was between 500 and 1000 crores, right? So that, and apart from that, it was a 6% dividend yield stock. I said it's a no-brainer, boss. I mean, pressure cooker penetration in the country has to rise. You cannot have people continuing to invest in cook through Teslas and all when there is a superior alternative there. So whether it was Hawkins or Prestige, they will give you disproportionate returns. So some of those are the concept behind sat traps. Bull traps, I think we all understand. I mean, we've just seen the startup meltdown. So जो भी bull market आता है, whenever there is a bull market in the industry, if you are investing in the leader of that bull run, so for instance, this time it was digital, last time it was NBFC, before that it was your real estate and infra, you will invariably get burnt. So just try and stay away from leaders of a bull run.
Right, Aditya. So, Aditya, any sectors which you feel could be good to explore for next 2 3 years maybe, and any space where you see too much pessimism or consolidation going on?
So I think textile is one space which I am closely watching. I'm not investing right now, and I don't think it will be investable for the next 12 months. But I think at some point of time, uh, textile will give you phenomenal returns. Another piece which I'm currently looking at and I'm wanting to invest and I've invested in is PSU banks. Another piece which I'm still to decide whether to invest through a stock or directly is the real estate. Another piece which I am looking at, which I have not done yet, but I want to do, is the Facebooks and the Googles of the world. So these are three, four sectors which I like. I think at this point of time, all of us should also have some part of our allocation to gold, which is from a 2 3 4 year horizon. It will not give you 15% return. It will give you probably 6 7 8% return, but as a substitute to your FD. And if you can do it through sovereign gold bonds, you get a 2.5% extra return through the government. You probably, because there is lower liquidity, you can get it at a discount to the fair value in the exchange, and then you can hold to maturity, so it does not matter. So I think some bit of gold exposure is not a bad thing to have, given the global scenario.
Right. So Aditya, any sectors to avoid, or maybe you see long-term headwinds in any of the sectors, and any view if you have on IT sector?
So IT, I think in the big boys, although I mean they're all great companies and they're all debt-free, cash flow throwing businesses and generating machines, so they will continue to do well, but they will see headwinds in terms of their growth over the next 2 3 years because of global recession that we are talking about. But in still you'll have companies like in IT there is a company called Cyient, which I think is run ups lately, but I think it's still relatively underpriced and has a larger exposure to digital component of the IT piece rather than services component and body shopping component. So I think that company should do better than give you better returns than some of the other pieces. In terms of sectors to avoid, uh, so uh, I think digital is still overdone. There will be further steep correction. Some of these darling companies are going to die out. But I also feel that some of these companies who remain might become behemoths later. So keep an eye, pick up at least 3 4 stocks where you feel that they've got their unit economics right, where cash burn is something which is not there or manageable, and they could do well. So, for instance, Info Edge or an India Mart, these are top-notch tech stocks. So probably they are a much better bet than people who are still burning a lot of cash. And the inherent value in Info Edge in terms of their underlying investments and their actually ability to. So that is another difference between say Info Edge and IndiaMart. I think Info Edge has been much more savvier with respect to their investing and capital allocation calls.
All right. So Shashank, any more questions from your side, or shall we, conclude for the day?
Just one last question. I was curious to know about your your reason for your bullishness on textile sector. Is there
So,
something
like I
specific you
said,
see?
I said I'm not bullish on textile sector immediately. I'm not allocating any capital to textile sector immediately, but I think that is one sector which is going to get beaten down over the next 1 year, and a lot of textile, good quality, high quality textile stocks will be available for a song over the next 12 months because of the global slowdown. That is the time to get in. And there is also
Oh,
China
I see.
plus one,
Okay.
right? So the
Hmm.
global supply chains for textile and everything, PVC, UPVC, building material, textile, iron and steel, everyone is looking to hedge from China, and that will happen irrespective. So the slowdown in the
Hmm.
textile space may not be as deep or as acute as a lot of people are fearing at this point of time. Because even if 10% of China's market comes to India, we'll probably double ourselves over the next 3 years.
Right, right. So would this be, let's say, a right space to look for, the kind of a leader like Symphony or some kind of that sort?
No,
Like you
not
said,
really.
look
So
for
it's a commodity
leaders
play. It's,
like of.
Symphony was a
Hmm.
brand play. It was a satrap kind of a
Okay,
play.
okay,
So this is more like a commodity play, right? So like if you would have made money,
okay.
I think anyone who invested in iron and steel over the last 4 5 years has made a killing, right? So I think it will be that kind of an
Okay.
opportunity. If you invest in textile over the next 12 months, or someone, for instance, your BOPP, BOPET space, if you invested 3 years ago, you would have made a killing.
Hmm.
So it is that kind of a play. It is not a satrap kind of a symphony kind of a play.
Okay. But do you see like any, like future Symphony type of a player? I mean, the
So
Indian market, do you see like, or is.
So there will be many. I mean, it's very difficult to crystal gauge. I mean, hindsight is 2020. Unfortunately, crystal gazing is not. But for instance, I mentioned basmati rice. I think basmati rice is one space which is a GI space. I mean, any rice. So anyone, even if you take the same seed and grow that in Vietnam, it will still not be called a basmati rice because it is a GI product. Only northern India and parts of
Right.
Pakistan, rice grown there can be called basmati rice. So there is a natural kind of a barrier for basmati rice, and basmati rice is loved in Middle East. These are high-paying geographies and Indian palate. So अभी तक क्या था कि we were still in terms of consumption and all, we are moving to a different space. I mean, as a child, I never remember having basmati rice at my home. Probably we didn't even have a fancy for basmati rice and all that. It would come only if you were making, some biryani or palav or something like that. Then you'll have. But as a staple, no one had basmati rice. But today, even in my household, and I'm sure amongst listeners, a lot of households will be using and eating basmati rice as a staple because we've got to a stage where on a food product, a 20, 30 rupees per kg kind of a price point, we don't even notice. So I think that will happen. Secondly, even if from a tactical point of view, I like it a lot because Pakistan had worst kind of a flood this year, and it happened in the basmati growing region. So this year, I expect the basmati production in Pakistan to be down by at least 15%. And uh, in a commodity like a staple or a food commodity, even a 3, 4, 5% reduction in production can lead to unusual rise in prices. So I think some of these domestic basmati rice companies are going to have a great year this year.
So
Right.
Aditya,
Very, very
like you
interesting.
talk, yeah. So Aditya, I won't name the companies, but if there are two companies, one keep a big inventory and the other doesn't keep big inventory, right? When it comes to basmati, aging is one thing which help with the quality of the rice, right? So do you see, I mean, if you get the name of the companies or maybe the theme, so how you see this inventory thing if we evaluate the
So
business?
let me answer this slightly generic in a generic way. If the inventory is if the company is over leveraged and has high inventory, I'll definitely avoid it. If the company's leverage is marginal or not there and he has a high inventory, I'll prefer it.
Right, fair enough, fair enough.
So
So,
let me slightly elaborate on what I am trying to say. Uh, if the company has high inventory and high leverage, there is a risk which I run, and because basmati rice guys have not been known to be the cleanest guys, there's a risk I run that the inventory is not there or is fictitious, which I, as a retail investor, has no way to verify. However, if, like you said, the aging is important and all that, if it is for that reason, nobody is going to declare supernormal profits to stock up inventory if he doesn't need working capital lines and pay tax on it. So if the inventory is genuine, obviously your realization on that becomes better. And in a year where I am expecting that the prices are going to spike on the basmati side, it will make even more sense.
right, right. So, are there any views on auto ancillaries and the pharma space? Are you evaluating any pockets within pharma?
So I'm not a pharma expert, and pharma is a very specialized thing. So I will skip that. But on auto ancillary, uh, I track that fairly aggressively, and I understand that space fairly well. Uh, my only submission to the group is don't jump into EV till it is a settled technology. Don't jump into companies which are running up because they will be great for EV in a hurry. Stay away from OEMs. look at technology agnostic stocks, for instance, automotive lights, axles, and some of these other pieces, or tires. Look at those kind of companies which will not get, which are technology agnostic and which are available at a decent price. Because I think, like it happened in solar, when it was growing and everything, I think there will be a huge amount of capital erosion and value loss in the EV space. One may feel that I wanted to buy that, and that particular stock has become a winner, so I should have invested. That is a very, very different thing. But as a industry, it is going to lose and tons of capital over the next 5 years. Obviously, you might feel bad that there was one particular winner which created a lot of value, but I was under invested there. So that is a risk one is should be willing to take. And if at all you have to back, do your diligence. Matlab, lot of incumbents might actually turn out to be better than some of the so-called fancier startups who are raising money at a very, very fancy valuation. Because automotive is a serious business. India, as a geography, has its own challenges. There are heating issues. There are short circuit issues. There are a lot of areas which have very, very long periods of monsoon. So to get the entire electrical piece right on that will take some time, especially on the four-wheeler space. Even in the two-wheeler space, people have had challenges. Four-wheeler will be even more challenging. So don't get too buoyed or too excited about EVs too early.
So same goes for the clean energy theme, which we are listening here and there.
Yeah, honestly, I think this is clean energy discussions are cocktail discussions. It's good to talk about. It's good to be nice about. It is not something which makes a lot of money.
Right, fair enough. So, Aditya, anything which I missed asking you, or you want to tell the audiences, which is covered in your book as well?
Uh, I think I had a fairly engaging discussion, and thanks, Prince, for hosting this. Uh, all I wanted to say is that if you wish, I mean, there is no need for everyone to be an investor, but if you wish to be an investor, please read a lot. We have very, very rich universe of books on the value investing side. Read, find your own style. Uh, Prince has been doing a great job, and there's another gentleman, Dhaval, from Investing Books. They keep highlighting some fantastic books which I have got hold of after reading their views on those books. So please read books as well as read annual reports. Don't cast your net too wide. Build competencies in few sectors. Build your own conviction in few strategies, few themes which you want to play out, and be dynamic about it. Don't think that what was good over the last 2 3 years will continue to be good forever. I think one of the surest way of losing capital or compromising a portfolio returns is by investing in sectors or stocks which have given phenomenal returns in the last 2 3 4 years. So please don't chase returns of a particular stock, but look at things in terms of a futuristic perspective. Whatever has happened in the past 2 3 years, you cannot go and buy stocks at a 3 year old price.
Great, great. So, thank you so much, Aditya, for your time, and it was great listening to your insights and the book. I can reckon that yeah, it's a good book, and in especially you find very little literature in Indian context. So all the case studies of Indian equity markets are there. So yeah, I personally liked it, and I think those who will read it surely will gain a different point of view, and that would be very helpful for them. So thank you, Aditya. We'll keep in touch for sure, and surely will request you sometime in future also. And for the
Thanks a
information
lot,
of
Prince. It was a
attendee,
pleasure and
yeah.
privilege.
So for the information of attendees, like next weekend on Saturday, we have spaces with Ashish Kila sir, and the Sunday we will be hosting Shashank Dogra, who's a speaker today also. So guys, have a look at the handle of Aditya sir, and trust me, the book you will find much more value than money. Of course, no sales or no recommendation on that front, but again, I personally liked, and when it comes to books, they really help you develop a overview in the sense like you get to know what are the things you need to avoid in the market, and that is the biggest thing you can learn. So with this, I take your leave for today. Thank you again, Aditya.
Thanks a ton, Prince. Thank you, Shashank. Thank you, Manish. Thank you, rest of the listeners. Really appreciate your time.
Thank you. Thank you. Good night. Thanks, Shashank.
Good.
Thank you. Thank you.